at some point you may determine that you need to, as we talked about, golden handcuff employees. If you are a S corporation, the problem you have with actual ownership is that an S corporation can only have two categories of stock, voting and non-voting. So you can't have, quote, vesting valuation. You can't have a period of time in which they get paid afterwards, and I'm going to explain that in a minute. With an S corp, which is why most S corps use phantom equity. But the concept that we say here is a couple of things. One, I never believe you give equity away. You do not give it. What you may say to the employee is, you're going to buy this, I'm going to take a discount because for lack of control, lack of marketability, so I can shave somewhere between 20 and 35% of the price off. You're going to pay this to us in the form of a note that has annual bonuses, and 70% of the annual bonus goes to pay the note, 30% goes to Uncle Sam. If an employee is not willing to give up the opportunity cost of a bonus to own equity in the company, he's not management material. Because most of them, if they're there for a paycheck, they're not management. And if they're not willing to at least give up the opportunity cost of buying in, then they're probably not the right person for your management team. Another point is this. Most employee golden handcuffs have a problem in my mind. If I said to you, I'm giving my employee some equity and we're selling a company, when is he going to get paid generally? At closing, right? Has that added any value to the business whatsoever? In fact, it may have hurt the value of the business, because if you just wrote this guy a check, what's his likelihood to put up with, excuse the expression, any BS from the new owner? Instead, you can say to this person, for this class of equity, I'm giving you 15% at closing. I'm giving you 70% at the earlier of 1 year after acquisition or 30 days after constructive termination. Constructive termination means if the acquirer changes his location, changes his salary, changes his responsibility. So you have the ability to go to your employee and say, look, I'm protecting you. I'm guaranteeing you that you're going to get the same compensation if I sell the business for at least 1 year, plus this bonus. If they mess with you, you get your bonus early. By doing that, one, you've added value to the business. Two is, you've increased the likelihood you're going to close, because that employee can't then interpose himself in your letter of intent to say, I'm not staying unless I get something. So you've quantified it. And as I said, if you can deliver an intact management team, you will add anywhere from 25 to 100 basis points to an EBITDA multiplier. And I'm going to tell you, in most cases, the equity you're going to give is substantially less than that. So it's actually a benefit for you. Now, and then the last piece is a funded covenant not to compete again. So if you can tell Gerber that they know that they're not going to lose any of your employees if they leave, are not going to steal any of your employees, they're not going to steal your key contacts, they're not going to steal customers for 2 years. 1 year there and 1 year covenant not to compete, how much more do you think they're willing to pay knowing they have that, and knowing also that if they don't like your management team, they're not going to have to worry about severance. They can use them for 2 months and say, we got everything we needed out of them, go, take your severance, have a nice life. Alternatively, it gives them 12 months to get comfortable with this, for the employee and them to get comfortable, so hopefully then they stay on past the 12 months. Now, one other thing I want to point out about, I said selling equity. Here's another point that people don't think about, which is, if a company sells its own equity, it's not a taxable transaction. A company does not recognize gain or loss on the sale of its own stock. So the idea here is, if you're going to give this employee a bonus to pay for the equity, whose pocket is it really coming out of? It's coming out of yours, right? So instead, now you're going to get 70, he's going to pay taxes at his lower rate compared to yours, and the after-tax amount you get to take out as a capital gain because you can take it out as a dividend. And so what we do is that only the founder's shares have a right to share in sales proceeds on the sale of stock to employees. So effectively, you can increase, during this period of time, you can actually increase what you're taking home because you're going to pay them a larger bonus and then you're going to get back 70, 80% of it in the form of a capital gain. So it's another thing, or if you're an LLC, it might even be non-taxable. So this is the concept of when I talk about stay bonuses. You may have certain key employees that aren't worth giving them equity to. However, you wouldn't want, if you got hit by a bus, you wouldn't want them walking out the door. So the idea of saying, whether I sell the business, whether I die, I'm going to pay you a stay bonus equal to, let's say, 50% of your W-2 income if you stay 12 months after that event. And getting them to be locked into the company going for that period of time. Because, you know, I've seen too many scenarios where the owner dies and there's no one there that runs the ship all of a sudden, and it's Katie bar the door. But if you've got your key employees that know, hey, we're going to stick because we're going to get this nice bonus because we're going to stick, you have a better chance of preserving the value of your business. A couple of things I also want to mention about the actual equity. If you give it to them, just so we're clear, that's a taxable event to them. If they get unbridled ownership and equity, they will have taxable income under what is known as Section 83 of the Internal Revenue Code, which says if you get equity for services, then you're going to pay taxes on it.
In that year?
In that year, based on the then fair market value less potential discounts. Now, this is why we use the loan and the buying for zero-sum gain, but there's also another thing that some clients don't want to necessarily do the loan, but they say, we're going to give you equity. However, the company's today worth $3 million. Your equity you only share in the appreciation beyond $3 million. So the point is, then they have zero current value because it's worth zero today because it's set at that value, and then they get a piece of the appreciation.
Each year?
Well, again, here, with depending on how you set it up. I have clients, if they use phantom plans, that they basically pay, some of them pay it in the form of a bonus. If you're using actual equity, sometimes there's dividends. Sometimes there's a performance bonus that's based on equity that you own. So there's an untold number of ways to actually deal with the specifics.